In August of 1942, in a modest house in Omaha, Nebraska, an 11-year-old boy picked up the phone and placed his first stock order. 3 shares, $38, everything he had. Nobody at the brokerage office paid attention. Why would they? America had just entered the Second World War. The country was rationing rubber, gasoline, and sugar. Factories were being converted overnight to produce tanks and aircraft instead of automobiles and refrigerators. The financial markets were nervous, uncertain, and largely ignored by ordinary Americans who had more immediate things to worry about. Serious investors were cautious. Banks were conservative. The memory of the 1929 crash, which had destroyed fortunes, wiped out savings, and pushed millions of Americans into poverty, was still fresh, still raw, still present in the minds of anyone over the age of 20. And here was a child putting his entire life savings into the stock market. That $38 became $132 billion. Warren Buffett is the greatest investor in the history of human capital markets. Not the richest person alive, though he has held that title too, but the most successful pure investor who ever lived. Every single dollar he put to work in 1942 is worth approximately $3.5 million today. No hedge fund, no algorithmic trading system, no lucky timing on a single explosive trade. Just a kid from Omaha, Nebraska, who figured out something about money that almost nobody else has ever fully understood, and then spent 80 years proving it, quietly, consistently, without drama, from the same office in the same city where he has lived his entire life. But here's what nobody talks about. That phone call in 1942, it was not the beginning of the story. By the time Warren Buffett made his first investment, the most important work was already done. The real compounding had started 6 years earlier, in 1936, when a 6-year-old boy walked into his grandfather's grocery store with a very specific plan. It wasn't compounding dollars, it was compounding knowledge. And this is where the story actually starts. 6 years old, summer, Omaha. Warren Buffett walked into his grandfather Ernest's grocery store and purchased 6 bottles of Coca-Cola from the family stock for 2005 cents, 4 cents a bottle, 1 cent below the standard retail price that Ernest charged his regular customers. He then walked through his neighborhood on a warm Nebraska afternoon, selling each bottle for a nickel to neighbors, passers-by, and anyone willing to pay for a cold drink on a hot day. Profit, 5 cents on 6 bottles. Margin, 20%. He was 6. Most children given access to a family store take something for themselves, a candy bar, a soda, something small and immediate and sweet. Warren Buffett identified a price differential, calculated the margin, executed the trade, and pocketed the spread. Not because he was greedy. By every account of people who knew him as a child, he was a generous and genuinely affectionate boy. But because the logic of the transaction was, to him, simply obvious. There was a price, there was a cost. The difference was his to capture. Why would you not capture it? He did this repeatedly through that summer. Coca-Cola first, then chewing gum, juicy fruit and doublemint, purchased in packs and sold stick by stick through his neighborhood at a small premium over what he had paid. The profit margins on individual sticks of gum were even better than on the soda. He understood, at 6, that breaking a product into smaller units and selling those units individually at a markup was more profitable than selling the whole thing at once. Then, at age 7, he went to the Aksar Ben racetrack with his grandfather and spent the afternoon collecting discarded betting tickets from the ground near the grandstands, carefully checking each one against the day's results to see if anyone had accidentally thrown away a ticket that had actually won. He found nothing of value, but the behavior itself, the patient, systematic search for something overlooked by others, the willingness to do the unglamorous work of checking every single discarded ticket, rather than assuming they were all worthless, was the same instinct that would later lead him to read every page of financial filings that other analysts had already dismissed as not worth their time. At age 8, he began reading his father's books on the stock market, not children's books, actual financial texts written for adults, with dense pages of data, terminology, and argument. He read a book called 1,000 Ways to Make $1,000, a practical guide to small business and money-making, published in 1936, and couldn't put it down. He also began working through security analysis, the 1934 masterwork by Benjamin Graham and David Dodd, which would eventually become the Bible of value investing. He did not fully understand it at 8. He kept reading anyway, The concept that transfixed him most was not any specific business idea, but the mathematics of compound interest. 1,000 Ways to Make $1,000 described a coin-counting machine that could generate recurring revenue simply from its placement in stores. The owner didn't need to do anything after the initial installation. The machine worked continuously, generating small amounts of money that added up over time. The image stayed with Warren with an almost physical intensity. A machine that made money while you slept. Not because you worked harder or were smarter than the competition on any given day, but because you had made one smart initial decision and then had the patience to let time do its work. Most people understand compound interest as a mathematical concept, something you learn in school, nod at, and largely ignore in practice. Warren Buffett understood it at 8 as a personal philosophy. Every dollar he spent on something that didn't grow was a dollar he wasn't putting to work. Every dollar invested was a dollar that could double, then double again, then double again, over enough time to become something unrecognizable. He began keeping careful records of his money, a small notebook where he tracked every cent he earned and every cent he spent. This habit of knowing exactly where the money was and exactly what it was doing never left him. 60 years later, Buffett would still be the kind of man who could tell you the precise cost basis of every major investment he had made. By the time he was 10, he had read every book in the Omaha Public Library's business section. Not skimmed, read, some of them more than once, returning to passages he wanted to understand more deeply. The $38 investment was still 2 years away. But the education that would make that investment meaningful, and that would eventually turn it into one of the most extraordinary financial stories in history, had been accumulating for years. The most important lesson was still to come. In the summer of 1941, Howard Buffett took his 11-year-old son on a trip to New York City. For a middle-class boy from Omaha who had spent his entire life in Nebraska, New York in 1941 was a different universe. The scale of the buildings, the density of the crowds, the noise and speed and sheer accumulated ambition of the city, everything happening at once, in every direction without pause. Most children Warren's age would have been overwhelmed or simply delighted by the spectacle. Warren was interested in one specific part of it. They visited the New York Stock Exchange on Wall Street, the physical trading floor where in the pre-electronic era, hundreds of men in jackets shouted buy and sell orders across a vast room that smelled of cigarette smoke, paper, and a particular kind of focused urgency. The floor was organized chaos, different trading posts for different securities, runners carrying order slips, specialists managing the books for individual stocks. Young Warren stood at the visitors' gallery and watched the whole thing with the complete calm of a scientist observing an experiment. He wasn't overwhelmed. He wasn't excited in a childish way. He was studying, filing away everything he saw. They also visited the offices of Harris Upham & Co., a brokerage firm where Howard had professional connections. The manager took them to lunch. Warren spent the meal asking questions that the adult brokers found startling in their specificity. Not the questions a child asks, not what is a stock or how does the market work. He already knew the answers to those questions. He had read the books. He was asking about price-to-earnings ratios, about the difference between book value and market value, about why certain stocks sometimes traded at prices below the liquidation value of the company's physical assets. Why, in other words, the market sometimes allowed you to buy $1 worth of stuff for 50 cents. He had been reading Benjamin Graham's security analysis for 3 years by this point, imperfectly, incompletely, but persistently. He understood, at 11, the core intellectual framework that would define his investment philosophy for the next 8 decades. A stock is not a ticker symbol or a number on a board. It is a fractional ownership stake in an actual business, with real assets, real revenues, real employees, and real prospects. And if you can buy that fractional stake for less than what the business is genuinely worth, you have what Graham called a margin of safety, a buffer against being wrong, a structural advantage that doesn't depend on being smarter than everyone else every single day. The following year, 1942, Warren acted on everything he had been learning. He had saved $38, accumulated over 5 years of selling gum, delivering newspapers, collecting and reselling golf balls, and executing every small commercial transaction he could identify in his neighborhood and school environment. $38 was the entirety of his savings. It represented years of work and patience and deferred spending. He approached his sister Doris, 3 years older, and considerably more skeptical of her younger brother's financial theories, with the proposition he had identified a stock he wanted to buy, City Service Preferred, a utility company that Howard sometimes discussed. Utility stocks were considered relatively stable, companies that provided electricity and gas to homes and businesses, with regulated revenues and predictable costs. Warren would buy 3 shares, 2 for himself, 1 for Doris. If it went up, they would both profit. If it went down, well, Warren was confident it wouldn't. It went down. Almost immediately after he bought it, City Service Preferred dropped from $38 per share to $27, an immediate loss of nearly 30%. For a child who had spent 5 years accumulating that money, $1 at a time, watching it shrink by almost a third in a matter of weeks, was genuinely painful. Doris, who had trusted her younger brother's confidence and was now watching her investment decline, reminded Warren of this development regularly and with considerable feeling. The conversations were not comfortable. Warren held. He did not sell. He watched the stock sit at $27, then $28, then slowly grinding its way upward through the spring and early summer of 1942. When it finally recovered to $40 per share, a gain of $2 above his original purchase price, he sold. Total profit, $6 across both their shares, a return of roughly 8%. He was pleased with himself for approximately 48 hours. Then he watched City's Service Preferred continue to climb, and keep climbing. The stock reached $100 per share, then $150, then, eventually, $200 per share. If Warren had simply held the position, if he had resisted the urge to take a small, safe profit, and instead trusted his original analysis, the $38 investment would have been worth roughly $500 within a few years. He was 12 years old, and he had just learned, in the most direct and personal way possible, what would become the single most important lesson of his entire investment career. The cost of impatience is enormous. Not just financially enormous, philosophically enormous. Selling a good business because the price had recovered to a small profit was not prudent. It was a failure of conviction. The real gains in investing, the life-changing, generational gains, don't come from buying low and selling slightly higher. They come from identifying something genuinely, durably valuable and then having the patience, the nerve, and the intellectual honesty to hold it while the rest of the world catches up to what you already knew. He never forgot the city's service lesson. It became encoded into his thinking so deeply that it is now inseparable from his public philosophy. Decades later, when asked about his investment approach, Buffett would describe his preferred holding period as forever. Business journalists treated this as a clever aphorism. It was actually a 12-year-old boy's promise to himself, kept across 80 years. Between the ages of 12 and 17, Warren Buffett did not slow down. He accelerated. At 13, he filed his first federal income tax return. He was working a newspaper delivery route, the Washington Post route in his neighborhood, which he executed with a kind of systematic efficiency that his school teachers would have recognized as characteristic of him. He was responsible for delivering several hundred papers before school each morning, in all weather, including the brutal Nebraska winters where temperatures regularly dropped well below freezing. His income that year was $592.50. On his tax return, he deducted his bicycle as a business expense. His wristwatch as well. He made the argument, apparently with a straight face, that the watch was a necessary business tool for timing his delivery route efficiently. The IRS did not challenge either deduction. Buffett has described this as one of his most satisfying early victories, and the pride in his voice when he tells the story suggests he finds it genuinely funny 60 years later. At 14, he took his accumulated newspaper earnings, approximately $2,200 which he had saved almost entirely rather than spending, and purchased 40 acres of farmland in Nebraska, which he then leased back to a local farmer under a profit-sharing arrangement. The farmer worked the land. Warren collected a portion of whatever the land produced. He was a landlord at 14, generating passive income from a physical asset he had purchased with earned income, while continuing his newspaper route and his studies. Look carefully at what is happening here. By the time most American teenagers were deciding what record to buy or which sport to play in the afternoons, Warren Buffett had already built and was simultaneously operating 3 completely distinct models of income generation. There was direct labor income from the newspaper route. There was passive income from the Nebraska farmland. And there was his ongoing investment in stocks, which represented capital appreciation, money growing not from labor or rental arrangements, but from the underlying value of businesses increasing over time. He wasn't following a plan that someone had given him. No adult had sat him down and explained the concept of income diversification, or passive versus active income. He was constructing a theory of wealth from first principles, testing each model empirically, and expanding the ones that worked while quietly abandoning the ones that didn't. He was doing, at 14, what most people don't start doing until their 40s, if they start at all. At 15, he and a close friend named Don Danley came across a used pinball machine available for purchase at $25. Warren proposed a business arrangement. They would buy the machine, place it in a local barber shop, split the proceeds with the barber, and use the profits to buy more machines. The barber agreed. The machine was installed. Within the first week, it had generated enough revenue to make the math obvious. This was a business worth expanding. Within a few months, they had placed pinball machines in 3 different barbershops across Omaha. The machines ran all day while Warren was in school, while he slept, while he was doing anything else. Each machine required minimal maintenance. The barbers were motivated partners because they earned money from the arrangement without doing anything beyond allowing the machine to sit in their shop. Buffett and Danley collected a steady stream of small revenues from multiple locations simultaneously. Buffett later valued the pinball business at approximately $1,300, 52 times his original $25 investment, before selling it at a profit to a local businessman who wanted to expand it further. The money from the pinball venture was not the important part. The structure was. Warren had, at 15, independently arrived at the concept of a capital-light, recurring revenue business model, the same model that would later make companies like Coca-Cola, See's Candies and Geico so attractive to him as an adult investor. A business where the initial capital investment is modest, the ongoing operational costs are low, the customer relationship is self-renewing, and the cash flows are predictable. The machine worked while he slept. He would spend the next 7 decades looking for this exact structure at progressively larger scales. But the most important thing happening during these years, more important than the newspaper route, more important than the farmland, more important than the pinball machines, was the reading. Warren was consuming financial and business literature at a pace that would have been remarkable in a graduate business school student, let alone a teenager in Omaha who also had homework, a part-time job, and a social life. He read every annual report he could get his hands on. He requested financial filings from companies that interested him. He read trade publications for industries he found compelling. He tracked stock prices in the newspaper with the same focused, habitual attention that other boys his age gave to batting averages and box scores. His father's library was exhausted. The public library's business section was exhausted. He was writing to companies directly, asking for their published reports. He was reading everything. By the time Warren Buffett graduated from high school in 1947, he had saved approximately $5,000, worth roughly $65,000 in today's purchasing power. He had generated every dollar of it through his own labor, his own investments, and his own business arrangements. He had also, by this point, absorbed more serious business and financial literature than most people read in their entire professional lives. He was 17 years old. He had already been a small businessman, an investor, a landlord, and an entrepreneur. And the most important chapter of his education was still ahead of him. In 1950, Warren Buffett applied to Harvard Business School. They rejected him. He was 20 years old. He had a documented investment track record stretching back 8 years. He had operated multiple businesses. He had saved and grown more money than most people his age had ever touched. He had read more relevant literature than many of the faculty members who would have been teaching him. The admissions interviewer apparently found him too young and too unconventional. It was the most fortuitous rejection in the history of American finance. Because Warren Buffett, looking for alternatives, discovered that Benjamin Graham, the man who had written Security Analysis, the book he had been reading and rereading since he was 8 years old, was teaching at Columbia Business School in New York City. Buffett applied immediately. He was admitted, and in the autumn of 1950, he walked into Graham's classroom for the first time. Benjamin Graham was 66 years old and had been thinking carefully about markets and value for 4 decades. His core intellectual contribution, The framework he had developed through painful personal experience of the 1929 crash and its aftermath was a systematic approach to identifying the difference between price and value. The stock market, Graham argued, was not a rational pricing mechanism. In the short term, it was a voting machine, responding to sentiment, fear, excitement, and fashion. In the long term, it was a weighing machine, converging on intrinsic value. The investor's job was to exploit the gap between short-term voting and long-term weighing, to buy when sentiment had pushed prices below fundamental value, and to hold until the weighing machine did its work. For Buffett, sitting in Graham's classroom was the intellectual equivalent of a devout believer finally meeting the person who had written their scripture. Everything he had intuited about business and value since he was 6 years old, everything he had tested through his own investments and business experiments, everything he had absorbed from years of reading, it was all here, organized, systematized, and taught with the authority of someone who had not just theorized it, but lived it through decades of actual market practice. Graham gave Buffett the only A+ he ever awarded in his teaching career. It was not a close call. After graduating from Columbia with a master's degree in economics in 1951, Buffett did something unusual. He offered to work for Graham's investment firm, Graham Newman Corporation, for free, without salary, without compensation of any kind. He simply wanted to learn by doing, at the feet of the person he considered the greatest investor alive. Graham declined. He had his reasons, partly practical, partly related to a policy of not hiring Jewish analysts at a time of significant discrimination in the industry, partly simply the limits of what the small firm could absorb. Buffett was persistent. He stayed in contact. He wrote letters. He generated investment ideas and sent them to Graham without being asked. Eventually, in 1954, Graham offered him a job at a salary of $12,000 per year. Buffett accepted without hesitation and moved to New York. He worked at Graham Newman for 2 years, from 1954 to 1956. What he learned there completed his formal investment education in ways that no classroom had been able to do. He was not just reading about value investing now, he was executing it daily with real money in real markets. Under the supervision of its inventor, he learned to be patient when the numbers were clear. He learned the discipline of sticking to a framework even when the market seemed to be telling you that the framework was wrong. But he also began to see something that Graham himself had never fully developed, a refinement of the teacher's philosophy that Buffett would later credit largely to his business partner Charlie Munger. Graham was looking essentially for bargains, dollar bills trading at 50 cents, assets worth more than their market prices, cigar butts with one last puff of value left in them. Buy cheap, extract the value, move on. Buffett began to sense that there was a higher category of investment than Graham's bargains. What if you could find a business that was not just cheap, but genuinely excellent? A business with such a strong competitive position that it could grow its value year after year, decade after decade, without requiring enormous ongoing capital investment. A business with what he would later call an economic moat, a durable structural advantage that kept competitors out and kept customers coming back, reliably, predictably, almost regardless of what was happening in the broader economy. Such a business might not be available at 50 cents on the dollar. It might only be available at 80 cents or 90 cents, or even exactly what it was worth. But if the underlying business kept growing, if the dollar you were buying kept becoming $1.10, then $1.20, then $2, then $4, then even paying full price for it was a bargain compared to buying a cheap asset that never grew. Graham was brilliant, but his method had limits. Buffett was beginning to see past them. He returned to Omaha in 1956. He was 25 years old and had $174,000 of his own money. On May 1st, 1956, he formed the Buffett Partnership Limited with 7 founding investors, family members and friends, who contributed $105,000 between them. He contributed $100 of his own money and operated the partnership from a bedroom in his house. No office, no team, no external research. Just Buffett, his telephone. The company reports he requested directly from businesses and the accumulated investment knowledge of a 25-year-old who had been seriously studying business for 17 years. The results were extraordinary. In its first full year, the Buffett partnership returned 25%, while the Dow Jones Industrial Average returned approximately 8%. In the second year, 32%. By 1961, the The partnership managed over $7 million. By 1965, it had grown to over $26 million in assets, and Buffett had compounded money at approximately 29% annually over 9 years, compared to the Dow's 8% over the same period. In 1965, he began quietly purchasing shares of a failing New England textile company called Berkshire Hathaway. The acquisition was, by his own later admission, a mistake born of spite. A dispute with management over $0.125 per share in a buyout offer had so irritated him that he bought a controlling stake just to fire the people who had annoyed him. He later estimated this emotional decision cost him roughly $200 billion in foregone compounding opportunity. But the vehicle became something extraordinary. Buffett used Berkshire not as a textile business, but as a financial holding company, a structure through which he could deploy capital into great businesses with durable competitive advantages. He bought Geico when it was nearly bankrupt. He bought See's Candies for $25 million and watched it generate over $2 billion in cumulative profits over the following decades. He bought the Washington Post Company at a quarter of what he estimated it was worth. He built an insurance operation that generated billions in float, the premium payments collected up front, before claims were paid, which he used as effectively free capital to make further investments. By 1985, a single Berkshire share had gone from $19 to over $2,000. By 1995, over $30,000. By 2023, over $500,000 per share. The $38 had become something that required a different kind of mathematics to describe. So we've seen how a 6-year-old selling Coca-Cola at a nickel a bottle grew into the greatest investor in history. The $38 was never the point. It was never the point. The point was what came before it and what it represented. 5 years of patient accumulation, 2 years of reading books that most adults never open, the Coca-Cola arbitrage at 6, the racetrack ticket search at 7, the pinball machines at 15, the Nebraska farmland at 14, the newspaper route at 13 that he ran in freezing Midwestern mornings before school. Warren Buffett arrived at his first stock trade already carrying more relevant preparation than most people accumulate in 30 years of professional finance. He didn't discover a secret. He didn't get lucky. He built a structure of knowledge, of habit, of temperament, of the specific kind of patience that comes from understanding at a deep level why patience pays. And that structure made things visible to him that other people genuinely could not see. Buffett's story is, in the end, a demonstration of what happens when intellectual curiosity is taken seriously from an early age and given the materials and the time it needs to develop. The reading habit he established before age 8 is still paying dividends at 93 years old. Every hour of genuine intellectual investment he made as a child compounded silently and invisibly over decades into the cognitive infrastructure that makes him unique. The truth that his story illustrates is not primarily about money. It is about the nature of compounding itself, the principle that small, consistent inputs, sustained over long periods, produce outputs that seem impossible until you understand the mathematics behind them. Money compounds, knowledge compounds, habits compound, the things you do every day, the questions you ask, the books you read, the problems you choose to think about. All of these compound quietly in directions you cannot fully predict into the person you eventually become. Warren Buffett compounded himself. The money was just the scoreboard. So the question remains, and it is worth sitting with, what are you compounding?